We're just giving people another couple of minutes, even though we are late. Okay, I think we should be starting. I just have an announcement which possibly has already come to you on the mail. In this room at 7 p.m. today, there's going to be showing of a, well, I don't know, film documentary called Tax Wars. It's about ICRICT and its work and of similar people working on the tax front. And it'll be, the program is about 15 minutes where the whole objective of the campaign, etc., is going to be presented by Jose Antonio and Joyati Ghosh and Martin Guzman, who are part of ICRICT. And so that's at 7 p.m. and at 6:30 p.m., I think it would be just outside, possibly. You'd be provided some refreshments and some cocktails as incentive to come and watch the film. Okay. So we now are going to start. Thank you. Will you introduce yourself?
Okay. Okay, so we're about to start the session on the role of private finance. We have three speakers. The first one is Devika Dutt, a lecturer at King's College in London. The second speaker will be Charles Abugre, who is the executive director of the IDEAS. And the third speaker will be Mmakamma Ekuruche, who is a senior research fellow at the Center for the Study and Economics of Africa, CISA. Okay, so we start first by Devika, and then Charles, and Ma. Please.
I got it. Yeah, I think so. I think so. I think it's on. Okay. All right. Great. Thanks, everyone, for being here. I feel very honored and privileged to be here and to speak to you all about the role of private finance, specifically because there are so many of my former professors from JNU in the room. So I feel very, very honored and a bit humbled to even share the stage with them. Anyway, to get started and straight to the point, I guess the topic of this panel is about the role of private finance in reforming those are not my slides, so just letting you know. It's the role of private finance in the international financial architecture. And we should ask, like, to do what? You know, what is the purpose of why do we want to reform the international financial architecture? And I guess if we consider the challenges that require financing for today, these are challenges related to hunger, nutrition, biodiversity loss, climate change, and the related extreme weather events, provision of crucial public services, and in the few parts of the world that global governance allows, industrial development. And several other crucial goals. The answer, unfortunately, about the role of private finance is that there should be no key role, in my view. There are two key points I want to make in this regard. First is it's in its key goals and incentives, private finance is unsuited to achieving these goals. And two, if much effort is made to bring forth sufficient private finance in the service of these goals, it would actually hinder their achievement, and therefore we should focus on other sources, which I can talk about briefly, but several other panels have already and will talk about this. So the first point is actually very easy and quick to make. I think that the provision of key public services and the achievement of development goals, if done properly, is not a profit-generating enterprise. It's as simple as that. And if it weren't, this whole conversation would be pointless, as private finance would already be flowing towards the achievement of these goals. Arguably, the most intense manifestation of the gaps in financing, or capital scarcity, if you can think of it in this way, is in the global south. And neoclassical economic theory would tell us that capital should flow to the capital scarce places and activities, as the marginal return to capital would be the highest there. This is obviously not borne out in reality, because once again, we would not be having this conversation. And in fact, mainstream economics refers to this as the paradox of capital. Further, private finance is not presently financing key important developmental projects, such as, for instance, public distribution systems where there's distributing food, financing of, say, large-scale, irrigation projects, large-scale industrial projects, provision of health, etc. Of course, we know that the private investment in public goods exists, but this doesn't mean that these services are genuinely public. Private hospitals, for instance, cannot spearhead citywide, let alone nationwide vaccination drives, for instance. They can't be involved in roads and railroads, and they can be involved in roads and railroads, let's say, but only at the expense of higher and exclusive user fees. And it's also important to consider that when private finance is forthcoming in service of key development goals, for instance, arguably there's a lot of private finance in the energy transition, specifically around production of electric vehicles, electric batteries for these electric vehicles. And so it's abundant with lots of investment in the production of electric cars, production of batteries, etc. Of course, this has only been after massive public investment, specifically in China. But there is no massive inflow of capital in the production of, say, or provision of public transportation, or in making it accessible. In fact, private financiers would have us believe that the future of transportation is, in fact, each one of us, everywhere in the world, having our own private electric vehicle, which is, if you think about it, genuinely insane. First of all, it cannot be supported by the lithium reserves that presently exist without going into massive problems related to extractivism, which I won't get into. So once again, the nature of private finance changes the conversation, especially in terms of what it's willing to finance and what it's not willing to finance. And that's sort of ceding key territory in terms of the financial architecture that I think we shouldn't do. The second point that I want to make is that the focus on private capital and on demanding that, on thinking about ways to have private capital forthcoming is actually slowing down at best, or actually harming progress towards global development goals. There's so countless examples of failed projects that required public sector to step in. So I can give you 3 examples immediately because I have the time. One from the city where I'm from, New Delhi. One from the place I spent a substantial amount of time, which is the US. Another from where I'm currently based in the UK. So in 2012, so the connection between the biggest central train station in New Delhi and the airport on the Delhi Metro was initially supposed to be a public-private partnership between the public Delhi Metro Rail Corporation and Reliance Infrastructure, owned by Anil Ambani, whose nephew, by the way, you've been seeing his wedding literally everywhere for 6 months, potentially for another 2, nobody knows when this wedding will be over. We're all sick of it. So it was supposed to be a public-private partnership between the Delhi Metro Rail Corporation and Reliance Infrastructure. The partnership broke down in 2012 because of disagreements over construction operations not being up to snuff, faulty parts, delay in construction, etc. Finally, it broke down in 2012, and after many delays, the Delhi Metro Rail Corporation took over the completion of the Airport Express link and also substantially lowered the fare once it took it over. And again, there was a dispute that was just settled. There was a risk that the Delhi Metro Rail Corporation will have to owe huge amounts of subsidies, which it previously owed. Thankfully, the Supreme Court ruled against that. So, but you never know, and that would have been absolutely catastrophic. The second example, again, there's so many, I'm just picking a few, of that, especially, this is from US Healthcare, a recently published paper in the Review of Financial Studies, I believe, showed evidence of increasing mortality in care homes where private equity ownership basically took over. And so the exact quote I can say, they show that private equity ownership leads to a patient cohort with lower health risk. However, after instrumenting for patient nursing home match, we find that public ownership, private equity ownership increases mortality by 11%. Like the investment by private equity is literally leading to higher mortality in key public services. So it's not something that we should definitely aspire to or try to get towards. Finally, in the UK, where I'm now based, we are reaping the rewards for decades of privatization of key public services. For instance, the rail network and specifically water. Not 2 months ago, I read in the news in London, the former colonizers of where I'm actually from, that, hey, maybe you shouldn't drink tap water today because there might be E. coli in it. Because the private water companies haven't invested in renewing the infrastructure for 3 decades. And this is absolutely bizarre, a situation you're in. And now they're talking about renationalizing water after executives have made a pretty sum at the expense of the people who live there, and I'm sure at the expense of their health. Similarly, they're talking about renationalizing train after train travel for distances as short as 200 kilometers or even less is more expensive than the cost of flying there. So this kind of privatization and the prioritization of private finance is actually harming everything, harming our progress towards development goals. Not to mention, if I focus specifically on climate goals, it's actually allowing greater emissions in terms of in this case, for train travel, encouraging air travel. All these and countless other examples show us that private capital is fundamentally unsuited to serve public goals and comes at a great public cost, not only in terms of taxpayer money, but also in terms of health, social costs, and the immense political costs that then creates. We are literally seeing race riots in the United Kingdom now, partly because, I would argue, the discontent created by this specific decline due to the prioritization of private finance and private capital in the provision of public goods, which has fundamentally not been able to do. Second thing about how private finance is, the prioritization of private finance is actually harming our progress towards developmental goals is the example of sovereign debt distress, which Martin talked about extensively earlier, specifically that a lot of the debt, the external debt that several governments has is private, which makes, again, restructuring very difficult. It also has, he also mentioned earlier in the panel the impact that vulture funds had way back in 2016 in Argentina. Once again, because of the prioritization of private finance, we're in the situation in which a lot of countries are in external debt distress, which cannot be resolved through multilateral negotiation because they're not, they're trying, but it's not as straightforward because the players involved. I will give final example on how the focus on private finance is actually undermining our progress towards developmental goals, is I'm going to give you the examples of European carbon markets. And this seems a bit abstract, so bear with me. So the focus on private finance also requires a determining of prices and returns on investment on things or goals that shouldn't necessarily be put in that calculus of cost benefit or price discovery and monetary benefits and a reliance on private markets. However, and because I say that, this creates odd dynamics without necessarily making progress towards development goals. So take the example of carbon markets and one of the oldest emissions trading schemes, the emissions trading scheme of the European Union. Adrienne Buller gives this example in her book, The Value of the Whale, so I've taken it from there. So if you want to read more about it, read that. Of the emission trading schemes, which is a mainstay for many years of it's a crowning sort of policy in US and EU climate policy. She provides evidence based on official data that the reduction in EU's overall emissions has been between 0 to 1.5% per year despite, again, the centrality of this policy in EU's climate policy. And even this figure has to do with industries that are excluded and included, so a lot of data issues. And the actual contribution, she shows, of carbon pricing markets to reduction in EU's total emissions has only been 3.8% over 15 years of operation. Also, we have to remember that regulation and monitoring of these processes requires public resources. Any market is typically, once again, it requires public administration to maintain those markets, to adjudicate on any disputes, and this requires public resources that are taken away from other important needs. And outrageously, many firms in high-emitting sectors have actually extracted nearly 50 billion euros from this scheme, since it, it allocates different polluters, different amounts of credits, and you can trade in them. And because of a variety of reasons, the biggest polluters have actually benefited instead of paying. It's flipping the polluter's pay principle literally on its head. So apart from the role that private finance has played in actively harming environment, worsening emissions, and the avenues provided for greenwashing, again, we all know about ESG bonds. It's basically a huge greenwashing exercise. And not to mention the hedge funds, pension funds, and other index funds that are literally profiting from apartheid in Gaza, which is evident from the worldwide demands for divestment. So once again, focus on private investment or trying to bring it forth in order to solve our developmental goals. One, does not work, and two, does not work in the way we want it to work, and two, it's actually harming the conversation and slowing us down, I would argue. Apart from this, the focus on public austerity and the bias against public financing and public ownership in the economy is unfortunately still present in the zeitgeist. That has created this idea of a financing gap as something that exists in nature, that we just discover. We walk out the door and we see a financing gap in the woods, essentially. And the key challenge has become that we must de-risk private investment, which once again, I love that in policy circles, there's so many euphemisms. Austerity has become financial consolidation, debt restructuring has become debt operations, and now basically making private investment in public goods profitable for the private sector has become de-risking, which once again is a euphemism for transferring public resources to private pockets. And it's important to recognize that all these examples that I've given you is to show that this is not necessarily cheaper for the public exchequer. It's not necessarily better from the view of our developmental goals. And it's not true that there is no alternative. There is an alternative, and it's very old school. I have nothing new to offer when it comes to the alternative, because the alternative is public finance. Of course, it's not a panacea, and it requires, we can talk about public sector corruption, as Jayati mentioned yesterday in her comments, that we need to have public sector accountability. But the private sector is not accountable to us at all. It only responds to prices, it only responds to investment, it only responds to people who have the most money. And that cannot be the purpose of the international financial architecture. So that is the alternative. The alternative is necessary that we rely on public finance, not to make investment profitable for private players, but to design investments and partnership only where needed with private sector to serve public goals. If the government socializes losses in order to bring forth whatever investment, then it must also socialize the benefits, and there's literally no way around it. So that's all I have to say. So I'll stop there.
Okay, thank you, Devika. So we can move to the second speech by Charles Abugre.
Forgive me, I would like to sit down. And I have a PowerPoint which will be projected but not run through. So I shall speak to my notes. So my presentation narrows down the topic a little bit. I want to focus on the role of private debt finance, and basically private debt finance in foreign exchange, which is external debt from the private sector. And basically would like to draw on the experience of Africa in the last 2 decades, and to explain a little bit what the attractions have been and what the actual experiences are with private finance, private debt finance, and what we might do about this situation. So for especially since the international oil crisis in the late 70s, which triggered a collapse in commodity prices at that time, many African countries suddenly found themselves indebted. The size of the debt stock was limited, but relative to the ability to service them, just like now, there were serious debt servicing obligations. Come the 1980s, mid-80s, the World Bank walks and the IMF walk into this situation, and for nearly two decades, virtually every country on the continent was subjected to very extreme levels of liberalization, as was explained early in the morning. And the mechanisms for this level of policy control were adjustment loans, supplemented by bilateral grants. And so for a long time, virtually most countries, save a few middle-income countries, basically lived on adjustment loans and bilateral grants. This is how is it that by the year 2000, another debt crisis emerged. And this debt crisis then stimulated another round of further liberalization under the highly indebted poor countries program, the multilateral debt relief program in particular. So after so many years, many African countries kind of felt humiliated by this repeated reliance on development assistance, although much of what was provided to it were loans, but mostly from official sources. Part of that humiliation was, and especially with the highly indebted poor country program, was expressed in the form of direct budget support. Now, the mechanisms of direct budget support really is that a bunch of donors in your country actually sit with the finance minister and determines every macroeconomic aggregate and the allocation of the entire budget, which is far bigger than their contribution to the budget. So basically, you had a very direct neo-colonial control on policies. And countries will haggle with their donors in their own countries regarding their budget priorities. Many countries were looking to get out of this situation. That's the first point. Second point, the need for infrastructure financing and financing for development sectors in particular, the practice at that time was to, if you didn't get it from the World Bank or a multilateral development bank, you try to raise it from commercial banks. But the process of raising money on project financing in commercial banks was complex and arduous, and basically was a project-by-project process. Many countries either did not have the capability to put together projects that were considered financeable, or that the cost of doing it was onerous, slow, and frustrating. It is within these two contexts, the feeling of total loss of sovereignty in public policy making, the difficulty of finding alternative sources of financing that was realistic, that became the major push factors towards private finance, especially after the collapse of the international financial crisis. The second, then there were pull factors. The pull factors included the fact that all of a sudden there was a lot more money in the private sector, cheap relative to even what was available in multilateral sectors, that governments were encouraged through repeated IMF programs to avail themselves to. So many availed themselves to it. Very recent, except for Tunisia, most of them actually went into the private capital market, especially the Eurobond markets, very late in the 2000s, and most of them in the 2010s, 2012, 2014, 2015. So it's a very recent phenomenon. The second pull factor was that there was a perception that if you access private capital, it was a mark of maturity in your economy. So you substituted official sources of finance for private finance because you had made progress. And many of these countries rebased their GDP in order to reduce, their debt to GDP ratios and make them more attractive. And so they, in that sense, even by rebasing their GDP, many countries suddenly became low middle income countries on the continent. So a low middle income country is rewarded by access to private capital markets. And then the benefits of the private capital and the private markets were oversold. So there were 4 benefits sold to countries. One is that private sources of capital, especially the Eurobond market, gives greater diversity in the creditor base for financing. So basically, you had a larger pool of creditors from which to draw money, and there was enhanced flexibility that went with it. The second is that it offered more freedom from policy conditionalities. As I mentioned, many countries were kind of fed up with policy conditionalities in a direct way because there were no, if you went to the Eurobond market, direct conditionalities. And the third attraction was that you could borrow a lot more money than you would be able to negotiate from bilateral and other official sources, because the money is in the Black Rocks, not in the World Banks. And the fourth is efficiency. Once you agree the deal, you got the money credited into your accounts quite rapidly, compared to the complicated processes that you go in negotiating any flows from a multilateral development bank, and their drip feeds and so on. So these 4 things created an attraction for many countries to go into private capital markets. So within a period of a decade, most of them, more than 70 deals were done over nearly $20 billion now in many of countries. The debt owed to the Eurobond market, and many of them have started to default. And the default is largely to private creditors. What is the experience? So the experience so far is the following. Many of them have come to realize that the private debt market is pro-cyclical. So when they really need the money, they can't get it. So Nigeria, there was an oil price crash, Nigeria needed to borrow $3 billion, and they were, blocked out of it. Similarly, Cote d'Ivoire, Benin, South Africa, just as commodity prices went down and they thought that they could bail themselves out from going into the bond market, they were also blocked out. And then COVID came. So during the period of COVID, which also basically hit commodity prices heavily, many of them were completely blocked out of it. At the time that the World Bank, the IMF had said to everybody that you should try and spend yourself out of the recessions and deal with the debt later. They just couldn't spend themselves out of the recessions. There was no place to spend, the source to spend themselves out of recession. So that was a shock to many of them. The second shock was when the interest rates went up, and they had built up, these loans were falling due. They did not, and they needed to refinance this loan. The opportunities for refinancing these loans completely dried up. And this is why many of them started to default. So that's the first one. The second thing is that they realized that actually the private capital markets is not conditionality free, and that private bond investors actually use the market conditions and through credit rating agencies to basically condition policy priorities. Secondly, many of them realize that those of them who have defaulted, that actually they have not freed themselves from the stranglehold of the IMF. But in addition, they now have to deal with another powerful player, which is the Institute for International Finance, which is the coalition of bondholders who all exert a heavy pressure on both the IMF and the credit rating agencies. So the framework, the power relations became even more grim. And thirdly, credit rating agencies have consistently driven up the costs of borrowing by Africans from the private capital markets. They are always telling bad stories, whether it is a fear of a political instability or some drought or the other. And these bad stories constantly then lead to higher and higher interest rates charged. So Senegal, Ivory Coast, Gambia, all of them, their yields, when they started to borrow, most of the yields are far higher than 10%. In some cases, in the case of Ghana, when they really were desperate, they could not borrow below 21%. It's crazy. And even with that 21% that they were ready to go for, they only managed to access about 30% of what they had floated. So credit rating agencies, became a serious problem for many of these countries that went it. And they found that they didn't have a way of influencing credit rating agencies. And there have been some studies by the African Union that have demonstrated what they consider specific anti-African biases, that basically push up the cost of private credit. Then they found that in order to continue to borrow from private capital markets, many of them are pushed to back their loans with assets. So they're basically now doing more or less another round of fire sales that they guarantee, basically block the asset and use the flows from it to borrow. So this securitization process is another mechanism for a total loss of control over the flows of income coming from commodities in particular. And some of them now were also there's a lot of pressure on them to transfer risks to domestic savers and taxpayers. And two interesting examples, Namibia was made to, basically buy the Eurobonds, get the Social Security Fund to buy the Eurobonds, to transfer the obligation to the Social Security Fund, which is pension funds. And currently, Ghana was the first country to be made to do domestic debt restructuring as a process of a conversation about external debt restructuring. And this the constituencies that were hit by this were pension fund holders and the banks. And there's a lot of protestation by pension fund holders. They managed to extricate themselves from it, but not the banks, and so on. Okay, so the experience with private credit, and the bond market, it's quite grim. Yet, if you ask many African policymakers, such as Kenya, that are desperately trying to avoid a default and implementing the most ruthless austerity program to avoid a default, you ask, why are you doing this? Even when what you are doing might well actually affect medium to long-term growth and the ability to rebound. And the reason is we want to be able to go back to the private capital markets. And this conversation really needs to be had. To conclude, I think to get out of this, the solution lies in the earlier conversation in the morning. Ndongo's point that essentially this is about foreign exchange. And we have to find a way to address this from the current account. We can't address this on the African continent without revisiting mineral contracts and the grabbing of mineral resources by foreign companies, because there's very little that flows back into the continent, whether or not commodity prices rise. That's the first one. And the second one is, that is really important to, discipline the domestic macroeconomy in a way that enables governments to rely on domestic currency for development and reduce the need for borrowing in external currency. Thank you.
Thank you, Charles. So we'll move to the final speech by Mma Ekuruche, please.
Hello, everyone. Special thanks to IDEAS for the invitation. And also, it took a bit more willpower than we initially imagined to get me here. So big thanks to them. The discussion on the role of private finance. My presentation will be focused on improving the scale, value, and focus on private finance, particularly as it relates to the African continent. Here, private finance will mostly refer to foreign direct investments. In some cases, debts owed to private creditors, but mostly to foreign direct investments. So I'll start off by benchmarking my presentation on the points that Charles made. Why are African countries jumping through several loopholes just to get back to the international capital markets? And that's because, simply put, public finance is just not enough to deliver development outcomes in the continent, right? So the African Union just produced a report that says that until 2030, we need about $1.6 trillion to meet the SDG goals, right? Again, the discussion is moving from billions to trillions. Public finance tax, for instance, is just, tax as a share of GDP is just about 16%. Yes, a little bit above the global average at 15%, but then again, we have a relatively low economic base, about 3 trillion. So 16% of 3 trillion gives us about $480 billion, which is basically 1/3 of what we need, even less than 1/3 of what we need to meet the SDG requirements, right? And so that's where the role of private finance, the importance of private finance in delivering development outcomes, particularly as it relates to Africa, its importance cannot be overemphasized. You know, we actually need, you know, alternative sources of income, sources of revenue, rather, aside public finance. That being said, despite the importance of private finance to the continent, private finance flows, in particular FDI flows, pales in comparison to other regions. I know we saw from Ndongo's slide earlier today how FDI has improved in the last, say, 3 decades from 1990s, but still, as at now, the FDI inflows to Africa is just about 2% of the global FDI inflows, right? Just 2%. Now, the IFC, which is the chief mobilizer of private finance between 2014 and 2023, only signed 2 transport infrastructure projects on the continent. So within an entire decade, the IFC was only able to sign 2 transport infrastructure projects. Compare that with 16 transport infrastructure projects in Latin America, right? So clearly, volume coming to the continent is very small. Secondly, the sectors, right, that attract private finance, as we've heard in previous sessions, are largely extractive sectors, right? So these sectors provide the adequate risk-return profile that allows private investors to participate. And so today, I will be sharing insights on how countries in Africa, which other developing countries can learn from as well, can improve the volume or scale, also the value of private finance, so basically getting better value for money, and then finally improve the target sectors or the focus sectors. So first, on improving the volume or scale. First, I would say de-risking. The previous presenter talked a bit about that, but I'm talking about de-risking not necessarily in the context of the government providing guarantees, so not finance-related de-risking, right? But in the context of enhancing economic and financial stability, 1. Also in the context of enhancing governance, 2. And 3rd, in the context of improving procurements. So first, economic and financial stability. We've talked about exchange rate risks, interest rate risks, so I'm not going to focus on that. But what I will focus on is the non-autonomous or the lack of independence of central banks in the region. So increasingly, we're having central banks finance governments, basically printing money to finance governments, right? This has led to domestic inflationary pressures, right? So apart from the exchange rate pass-through effects that is causing inflation, a lot of the inflation that we're seeing on the continent also has to do with central bank monetary financing, right? Secondly, treasury bills, we have relatively high interest rates on treasury bills. And so what this does is that commercial banks in most countries would rather buy treasury bills than lend to the real sector, right? And so in that way, the real sector has no capital to scale production and then contribute to tax, you know, and then that's contributed to the development of the country, right? The second point on governance, corruption, yes, rule of law, yes, but also in terms of, in the context of policy somersaults, right? All these factors dissuade private investors. So for Nigeria, for instance, one moment you're talking about a digital currency, the next moment you're banning cryptocurrencies, right? Or cryptocurrency exchanges. So that mixed signaling from country authorities is an issue. And then third, procurement issues. In a lot of countries on the continent, it is very possible for a government official's nephew to purchase, for instance, uniforms of customs officials, right, at ×4 of the cost, right? In a context where financing is already an issue, that poses a serious problem. So that's with regards to de-risking. Moving on to the second point, which is value for money. So basically, which is value for money. So basically, given the limited financing options that we have, how do we improve or increase the value for money? I was speaking to one of the professors I respect a lot this morning, Professor Ugo Paniza, and then he says, oh, you know, not all assets are created equal. And it really stuck with me, right? So if you develop a road from a production center to a port, you're likely to have higher multiplier effects compared to if you develop a road from the city center to, say, the village of the president's grandmother, right? Yeah, just as an example. So multiplier effects in terms of increase in property tax, revenue on that road, also in terms of increase in income-based tax revenue as well. So there are going to be backward and forward linkages with other industries, also across the value chain, right? The segments of production. So increasing or improving value for money is very important. Yes, there are certain things we may not have control over, right? But in terms of deciding, and by we, I mean country authorities in Africa or in the developing world. But in terms of the decision on how scarce public or private revenues are spent, we should be able to, objectively fund projects that would enhance our fiscal space, right, and improve fiscal sustainability. So that's the third point, the value for money. And then the second point, rather. And then the third point is on focusing, right, so targeting. I know Martin earlier talked about how there's a lot of greenwashing going on, right? So private financing, say green bonds are issued, but at the end of the day, the funds are not used for green or related projects, right? But then there's a way to go around that, right? There are third-party evaluations. So in my opinion, I won't totally scrap out green bonds, blue bonds, sustainability-linked bonds, because to a large extent, some funds from that are realized from issuing these bonds are used for sustainability-linked projects. What I would suggest is to have third-party evaluations. Impact evaluations are a huge part of development now. So have third-party evaluations around these projects. That being said, my final point is it's better to, how is it said? change begins with me, right? So there's only so much developing countries can do to really move the needle with the global financial architecture, right? However, there are faulty domestic economic processes that they have control over, that they can influence, right? And so, in summary, that will be improving the scale of private finance, also improving the value for money, and then finally, better targeting of private finance. Thank you.
Thank you, Ma. So we now have time to collect 3 questions. Please, if you want to ask something. Okay, Chandra. Okay, this, you and you, yes. Starting here, yes.
Okay, I want to play devil's advocate. Okay, if we go back to, let's say, the decolonization period, and when some countries chose mixed economies as opposed to having had a revolution and having central planning and so on. And the presumption was that while the state has to play an important role, both as investor and producer, but also as a regulator, that there has to be a role for the private sector, right? Because of the fact that a large part of savings and investment decisions occur in the private sector. So the whole idea was that you needed to do 2 things. You needed to actually persuade, cajole, whatever it may be, the private sector to do things which are according to your plan, not according to what price incentives give it. And in return for that, you combine some carrots and some sticks, some regulation and some incentives, differential interest rates, some subsidies on exports, some contribution to R&D, etc., or tax rebates on R&D, etc. That is one level. And then, of course, this was in exaggerated form seen in what was celebrated as the developmental states, whether you agree with that. So, in some, there was a period in which it was accepted that the state can, if you are not going to wait for the revolution and central planning, the state can, in some sense, prod, incentivize, regulate, and discipline the private sector into doing certain things. Are you saying that that is no longer possible?
This lady here, yes, you? No, this and the other, yes.
Thank you. This was a really interesting panel. So my question is, what is the 2 questions actually? What is the reason that public funds continue to be so low? Like the gap between the what we need to reach development goals and what we actually are able to garner, and what are the changes that can be made in order to improve domestic resource mobilization, especially in the context of the things that are being said around like the capture of profits from like mineral exports and all of that. And also my other question is around the narrative around like public sector being inefficient, ineffective, and that really being central to kind of the weight given to what the private sector can do and all the positive things that we kind of expect from it. So how, what are the ways that we can counter that, and also keep the public sector essentially accountable, when it isn't always the case in many developing countries? Yep.
Thank you very much. I really enjoyed this session. All the presenters have spoken to some of the key issues that we're grappling with when it comes to determining first the resource envelope required to achieve the objectives of the state, and following from there, how do we get the financing itself? If I can speak to the point made by the first speaker, indeed, financialization, as we put it now, has led to a situation where society has suboptimal outcomes, and that is well documented in the literature. But a key point I see is that even if you look at some of the costing exercises of the SDGs, it is clear that this is not something that should be financed 100% by the public sector. And if you look at the SDG goals too, be it education, health, or even issues relating to the environment, implicit in those goals are some areas that are just best implemented by the private sector. So when you then look at the costing exercises, ranges from 50% for public sector, 50% for private sector in middle income economies, but in lower income economies, maybe a lot more for the public sector to finance. So what that means is that having some of these projects or programs devolved to the private sector in and of itself may not be the problem. I think the problem could just be that the state's regulatory capacity, its capacity to achieve its objectives in that particular framework is limited by whatever reason, and it could be cronyism, as you have identified, or any other reason. So I still believe that there is a role for the private sector in development. Now, I should also emphasize that, yes, the assumption, say in the 60s, 70s, is that many countries were going through a state-led growth, and then the Soviet Union collapsed, and the World Bank got out of industrial policy, and then started pushing countries into these privatization exercises, which then transferred some of these resources to the private sector. But the evidence, and that supports your point, is just that in many countries it just didn't work the way that we expect it to work. So I will say that, one, as part of some of the issues we're looking at for the reform of the international financial architecture, going back to some form of industrial planning or industrial policy and planning should be part of it. And not only that, the state, the capacity of the state to achieve its objectives should also be part of the discussion. Thank you.
Okay, thank you. I think we have questions enough. I will suggest you to reply in order you present. Is that fine? Okay.
Great. Thank you so much for the questions. Yeah, of course, I didn't get to everything because 15 minutes, and get riled up enough so I can talk forever bashing private finance. No, absolutely, like carrots and sticks are absolutely important, but I think we basically agree that the key commanding heights, see how old-fashioned I am, have to remain public. And I guess what I didn't also get to say is that this is not a plea to say like private finance should do nothing. It's just that we shouldn't be waiting around for it. That's really it. And that's the tiniest point that I wanted to make. Because regulation is possible, bringing it forth in terms of and imposing conditionalities, once again, as Charity mentioned yesterday at the event in the evening, that it's absolutely possible and necessary. It's just that we shouldn't wait around for it. And also that, as we know, that public investment will crowd in private investment. It's not automatically going to become a lot more profitable without, maybe in a different way. So yeah, really, I'm not really making that ambitious a point, much smaller. I think regards to public funds, I'll let you guys answer that. because you mentioned it in your talk as well. Regarding the public sector being inefficient, or the SDGs shouldn't only be financed by public sector. Once again, like similar to the response that I gave earlier, I think partly is that. But also, I don't see why the SDGs have to be, yeah, I mean, what is the theoretical or necessarily logical reason why SDGs have to have like certain percentage of private finance? If it's only the question of like quantity, then once again, like there's several tools that are obviously limited with global political economy, how much we can use them. But yeah, we have several tools to generate public finance related, I'm sure we'll hear in the evening about tax wars, and like what is to say that we can't actually raise that much tax revenue or through other mechanisms raise that amount of public finance. And part of about like public sector being inefficient, of course, like I'm not denying, I'm not living in an alternate reality where I'm saying it's perfect. I'm from India, I know public sector inefficiency. I know it very well, unfortunately. That being said, the private sector is deeply, deeply inefficient, and it's underappreciated how inefficient it is. In fact, the large amounts of like oopsie daisies, we just, CrowdStrike literally was like wiped off billions in capital value for so many companies, and nobody's like talking about it in terms of, oh, private sector monopolies are inherently inefficient, as opposed to if a public sector system goes down for whatever reason, which again happens all the time, oh no, public sector is definitely by design inefficient. That's literally, I don't know, that doesn't make sense in my book. So, and also, finally agree with you, industrial policy and planning, state capacity have to be part of it. This is sort of I recently found out about what the literature on political settlement is in development studies. I didn't know that before, betraying my ignorance. And apparently some of the narrative in there is that about how some of it is that public sector inefficiency, corruption, rent-seeking also you can think of partly as it is being like the state for decades, especially in the global south, being chronically underfinanced, which also creates opportunities for rent-seeking. So, of course, we need public sector accountability, but we also need more public sector. So, yeah, those short answers. They were not short, sorry.
There is a way that the concept of private sector is a very fluid concept. So in one sense, all economic actors outside of the state are in the private sector, and they express their activities in different forms. And all of that contributes to, overall aggregate demand, which is private sector demand. But they are different in political economy terms. There are different organizational structures in the private sector. So you have large transnational companies, and you have small businesses and their associations, and so on. You have cooperatives, which are not state, they are private. All of these actors contribute to MDGs or SDGs, and they are put together the larger part of the overall economy. It's important to clarify when we talk about private sector. So the smaller units, and they tend to be quite efficient, but they don't earn sufficient real wages to survive. The very large units rely a lot on subsidies. State subsidies, all sorts of tax concessions, they require the state to invest heavily in infrastructure to create the conditions for profitability. Some pay their taxes, most don't pay. So part of the conversation this evening on the tax question is that it is the ways to transfer capital outside of the tax preview of the state. And so one has to be quite clear what we are talking about.
All right. So I'll just respond to Mayada's question. I think Charles addressed it a bit, but I'll just give, you know, a few more additions. So the answer is pretty simple when it comes to why domestic resource mobilization is so low, right? The companies that pay tax simply don't earn enough profits, right? And then the ones that earn enough profits do not pay tax, right? So, for instance, small and medium sized businesses, it's easier for the government to collect tax from them, but then their productivity levels are lower. They don't have as much access to cheap or affordable finance. They don't have the best manpower, and so they can't scale, right? However, the multinationals, the large indigenous companies, like Charles pointed out, they have tons of tax concessions, tax subsidies, basically, right? So that's the straightforward answer.
Okay, we are perfectly on time. Okay, so we finished the session. Thank you, everybody.
So hi, everyone. Thank you again. Just two announcements. There is a coffee break now. After that, we are going to our last session, which I think is the most important. I don't know why. But after that session, we have the screening of the documentary Tax Wars, and Professor Jayati Ghosh, Professor Guzman, and Professor Ocampo are going to present. And the screening is going to be at 7. However, between 6 and 7, we are having some snacks and wine in here. And the screening is going to be in this room. So you are all invited to participate also. Thank you.